I've been an options trader now for quite a while, and it's just really increased the portfolio size. One of the things that we've discussed is, so I had my first $1 million in a day, and it was with options. Hi guys, I'm Teri Ijeoma, founder of Trade and Travel.
And I'm Lynnette Khalfani-Cox, the money coach. I'm the CEO and co-founder of AskTheMoneyCoach.com.
And today's topic is options trading. Guys, I'm so excited about this one because for a long time, I only traded stocks. And when other people would tell me, have you ever tried options? I'd say, no, that's too hard. No, it's too risky. I don't know what it is.
It's me.
That's you, Lynette.
That's what I've been saying.
See? Oh, but it's not. And it's actually a really cool way to amplify your investing. So I want to tell you today, like, what it is and why it's important. Sound good?
Sounds good.
Okay. So first, what is options trading? Options trading is trading a contract of an asset, and it's trading 100 shares of that at a time. The better way to put this is, have you ever bought a house or did like a lease to own on a house? I know for me in Puerto Rico, I have one house where I'm leasing it for 2 years, and then at the end, I have the option to buy it.
Correct.
That's what's happening in options. You literally are leasing shares, and then at the end of a certain expiration, you have an option to buy it or sell it.
So the options contract gives you the right, but not necessarily the obligation to buy a given asset or security.
Correct.
Okay.
If you're the buyer of an options contract, and I'll primarily talk to options in stocks, but you can do options on any asset class, commodities, futures. But for me, I'm thinking options on stocks. When you are buying a contract of, let's say you're buying a contract of Apple shares, that would say, I want to buy 100 shares of Apple at this price at this expiration date in the future. Just like a housing contract, you're buying a house. You say, I want to buy this house for this price at this date for closing, right? Literally, that's what you're saying in options. And you don't have to buy it at that price, but you have the ability to. That's where you're saying you have the right, but not the obligation. Because if you decide at expiration that, you know what, I actually don't really want this contract anymore, I don't want those shares, then you'll pay a premium, but that's all you got to do. Take my premium, but I don't have to keep the contract.
So when you're giving yourself the right to buy this, kind of on a lease basis, as you've described the analogy, how much are you putting up initially up front in order to get access or potentially control of those 100 shares? I imagine, obviously, it's not the full amount of the money, the 100 shares. It must be a fraction or a tiny percentage of that. Is that correct?
Yeah, great question. That's called a premium.
Okay.
So you'll put a premium up, and the premium will say, I'm willing to pay you $100 to hold this contract till expiration. If I decide later I don't want it, you can keep my $100. And that premium will change based on the asset. So based on the stock, the underlying stock that you're trading, based on the time, like how long do you have until that contract expires? That affects the premium. And then you go into all these other words like in the money, out of the money, all that stuff. But the basics is time and the underlying price of the stock are the things that impact the premium the most.
Okay. Mm-hmm. So let's talk a little bit now about why some of this is important when it comes to trading options and about how it can benefit people who choose to go ahead and make this play. Okay?
Yeah. So let's talk about the Apple example I was just discussing. So if I wanted to control 100 shares of Apple, and let's just say for ease, the Apple shares were $200. If I actually wanted to buy that in stock, I'd have to pay 100 times 200, which is $20,000 to control 100 shares of Apple. That's a lot of money, yes. $20,000.
Yes.
But at the same time, because one contract is 100 shares, if I said, you know what, I actually want to have a contract to control those 100 shares of Apple, and the premium was usually it's pretty low. It's actually like $2, $3, but then you time per share. So you times that by the number of shares. So you'd say, okay, $2 per share to hold this contract.
So
times
200
100,
bucks.
$200. So that's a big difference
between $200 versus $20,000 coming out of pocket. Yeah.
So that's one big difference. It's important because you can actually invest in more shares at a time for a lower amount of money.
Okay.
So that's a big deal. Another reason why this is important is because it's a hedge. And this is going to sound a little confusing, so I'll go slow. But remember, a contract is saying, you know what, I will buy or sell this many shares at this date in the future. Well, what if you have 100 shares of Apple already? And you wanted a contract that says, you know what, I'll sell this to you in the future for this price. Well, now you have some security that no matter what happens, you have a contract on the side that you can sell these stocks at some other price. So, for example, the way that many people do this is they'll say, I'm going to buy 100 shares and I have them at, let's just say, $147. I'm using an abstract number so that this makes sense. I bought 100 shares at $147. But I'm going to sell a contract of options that says if it gets to 157, I'll sell. Right? Mm-hmm. So now you're protecting your investment. You have shares and you have a contract that immediately says if it gets to 157, I'll sell. Or a lot of times people do this, it's called a covered call. They'll sell that contract and say, how about you just pay me a little bit to just hold on to this contract?
So you would have made $1,000 in that example. If I'm understanding you correctly, you make $10 per share, the difference between the 147 and the 157. And if it was for 100 shares times $10, you made $1,000.
Yes.
Is that right? Okay.
Yep.
Got it.
And if it doesn't get to 157, you still have a contract though that says that you can sell it.
Sell it. Mm-hmm.
So a lot of people use this just as comfort and security. And often they will do it on the reverse side. So they'll say, you know what? I bought my stocks at $147. I want to just have some protection that if it goes down to 137, there's a contract in the midst that I can get out of this or not lose everything.
So what if somebody doesn't have those shares up front, right? What if they, have this contract and they know that I can buy 100 shares in the future at X date and time. Mm-hmm. When do people make that calculus and that decision to say, I'm going to go ahead and buy if they don't already have the shares? Are they just watching the pricing and saying like, oh, it hit a certain price that's lower than the contracted price that I agreed to pay. Let me buy it now. Or are they doing it at the very last minute? When do they make that decision about whether or not to exercise their right to be able to purchase those shares?
So I'll tell you from trade and travel strategy. Okay. So in trade and travel, we look at charts to determine when to get in and out of a stock, period. Okay. So one thing that's really important with learning how to trade options is you need to know how to trade the underlying stock. So if you're asking like, when do I know when to buy the option? It would be if the stock price comes down and you were thinking about actually buying the stock, you could also buy the option at that time. Yep. Okay. And then the other part of the question is, well, how do you actually make money if you don't own the stock first? How would you make money on just the option? Well, it's a contract. So think of it like we were talking about the houses. I have a contract to buy this house. And if all of a sudden Walmart says they're going to build next to me, now all of a sudden the value of my house just went up. So the value of this contract just went up just by the idea that Walmart's coming. And you'd make money on the fact that the contract gained value.
I get it. As a real estate investor, I totally get that analogy because you can flip a property. You can assign the right to purchase the property. Like if you secure the right to purchase it, as long as you say, okay, yeah, I'm going to go through with the deal, but you might sell it over there to another investor who
like wholesaling,
who's willing to pay more for that property than what you agreed. The seller's still going to be like, okay, great. They're going to be like, fine, as long as you have a buyer that's going to come in and make the sale happen. Yeah. So yeah.
So the way you make money in options is the value of your contract has to increase.
Has to rise.
So earlier we were talking about Apple and saying that when I bought it for $2 per share. So I ended up paying $200 to control 100 shares of Apple. Well, if Apple goes up, the underlying stock price goes up. Well, now all of a sudden that same contract is worth $3 per share. So now I can sell that contract and say, you know what? I bought it for $200. I'm going to sell it for $300 and keep $100.
So that options contract is all is also a way to generate income on that basis. Okay, got it. Even if you don't ultimately purchase the shares.
Yes, exactly.
Got it. Okay.
So that's right now, the two things that are most important about options is you can trade and have access to more shares with less amount of money. You can make income on selling the options contract, right? You get it low and then you sell it high, just like any other stock or asset class. And then you can also use it to hedge and protect your portfolio. Because if you have some contract that can guarantee you a price, then you have a little bit more security in your portfolio.
And, kind of moving into our 2 cents, even though I have been one of those people who like, I don't know if this is for me. I'm kind of scared. Is this really too risky? Is this, the right move? I do see how it's less capital intensive. I do understand, like you said, there's the risk factor involved. And you do have to have a little more knowledge because you have to understand first how to trade the underlying stock and get your entry and potentially exit point.
Yeah.
But the fact that it's less capital intensive, that makes it really attractive for me as an investor to think about like, oh, okay, as I'm allocating my money to different things, I could trade stock options and do it for less money than buying the actual shares.
Yes.
So that makes sense to me.
Yeah. And when I talk about my 2 cents, so I've been an options trader now for quite a while, and it's just really increased the portfolio size. One of the things that we've discussed is, so I had my first $1 million in a day, and it was with options. And because you can access and control a lot of shares at a time with less money.
It magnifies the amount that you're able to get.
Yes. But on the teacher hat, the teacher side of me, I want to remind you, though, that because you can control more assets at a time, it's also more risky. So a lot of times people will lose a lot of money with options because time value, as you get closer to expiring, like that contract, as it gets closer to being like, it's expiration date,
out of the money.
Yeah. When the expiration date comes, it's going to start losing value really fast. And a lot of new traders don't factor in time value. So there's a lot of risk if you don't know what you're doing. Or if you don't give it enough time. That's a big factor. Speaking
of time, maybe you can answer this question as well. Like, what is the typical time frame for these options contracts? Are they like 30-day contracts, 60-day contracts, 6 months, 2 weeks? What are the sort of time increments that people might anticipate?
Great question. They actually start in weekly increments, but they can go for years out. Like, even in 2022, there's some 2024 contracts, 2 years from now, 3 years from now. So if you're a longer term investor, you can still take advantage of, they're called leaps, long-term options.
I wonder if that's considered, is that more speculative or is that less speculative? Because you're giving yourself a longer time horizon to kind of have to deal with, but then a lot could happen in the space of 2 years. You know what I mean?
But you think about like following the indexes. If you did an option following an index, the assumption is that over time it'll go up.
It'll go up.
So now you have access to a lot more shares of a ETF following an index than you would with just a small amount of money. Your return percentage can be a lot higher.
So overall, those contracts that are longer dated, those are more expensive.
Yes, they're more expensive.
And less risky. Is that the idea? Okay, got it. And the contracts that have a shorter time frame are cheaper, are less costly, but then potentially riskier.
Yes, because they'll start losing value
faster. Okay, got it. Okay.
For those that are trading options, a couple ideas that I would give you is you always want to pick a farther out expiration, even if you're not planning to hold on to the contract very long.
For that time.
You can sell before it expires. That's a question I often get. Like, do you have to hold it the whole time? No. Even if I got a contract for a year from now, I could sell it in a month.
Again, can I bring in a real estate analogy?
Yeah, please.
I haven't traded any stock options, so I'm sort of making my brain use analogies to think, and maybe this will be helpful to some of you. But again, I'm thinking about, if you buy a property and if you invest in real estate, and I have invested in real estate and have multiple properties, some of which have mortgages on them. So know that in some cases, I'm going to keep this property forever. And a 30-year fixed rate mortgage might be the best option from a financial standpoint in terms of financing. But then for some things, you might look at a 10-1 ARM, you might look at a 7-1 ARM, an adjustable rate mortgage. If you think I'm only going to have this property for like 3 years, maybe 5 years, then I'm going to sell it. I'm just trying to get in and get some price appreciation, then I'm going to sell. But you might say, I know I'm not going to keep the property for 7 years, but I'm still going to have a ARM that's 7 years, a little bit longer than the 3 to 5 years that I anticipate being in this house or owning this property, as a little bit of a protection there. So that's kind of the same.
Yes, kind of the same. Yeah.
Mindset. Yeah.
You know what's crazy? Like we are keeping this very basic for you guys, like more the ABCs of investing versus the advanced. But I will say that oftentimes people sell options contracts instead of buying options contracts. And when you sell, you actually take in money in advance. And then you are obligated to sell the stock at a certain price. But because you're taking in a premium, the goal is if the stock never comes to the price of this contract, then I just get to keep the premium, like insurance.
Oh, wow.
Yeah. You know how insurance, you
talk about generating some income.
Right. You have to pay money every month, and it's just like
a risk factor.
If nothing happens, then they just keep the money.
They just keep that money.
But if something does happen, they'll pay you out. Mm-hmm. That's when selling options, that's what you do. You say, and like what people do is they pick a stock price far away from the current price. So that there's a hope that nobody will ever hit that price.
Yeah, exactly.
Yeah. And they're like, okay,
I'll do it. I'll collect that money.
Take in $20, take in $100. So that's another thing that might be good on your long-term shares. Mm-hmm. Like, you know what? I'm going to have this for a long time. So let me just sell some options far away. And the cool thing is, if the stock actually reaches that price, you'd be happy anyway.
Right.
Because you'd be happy the stock went up.
Okay, it went up here. Sure, I'm okay to sell. Yeah, at that price. Yeah, just give me my money.
And if you do it without the underlying stock, it's called a naked option. Mm-hmm. And that's like really advanced traders need that. But just know that that's available. You can sell options and bring in income on a regular basis, or you can buy an option and just hope that the underlying stock increases so that the value of the contract.
Again, guys, listen to what we're saying to you. She just threw out a phrase, trading a naked option. Again, obviously that's more risky if you don't have the underlying security. But like she said, if you do actually own shares of the stock already, and you'd be perfectly happy to sell it if it went up to, X price times, 40% or whatever in the future, you would be like, okay, great, I'm out. I'll just sell it and be out at that price. And I made my money and I'm good with that. So naked, selling would be a little more risky, because then what if it doesn't go your way? I'm sure that there's, the risk and the potential downside for that.
And someone may ask that, like, Teri, what happens if the contract happens and you are, they call it in the money, but what if you have to actually pay some money out? Well, you have to pay some money out.
Yeah. You got to pay the piper. You got to
make money on options, or you can lose money. And you have to have risk management in options trading the same way you do with stocks. So if you see that the contract is starting to lose value, you can get out of the trade before it expires as well. You don't have to lose all your money. So be mindful of that. And you can use something called a stop loss, which is an order type that will protect you if the price goes down. You can use that for an options contract too. If the options contract goes down a little bit, the stock can take you out of that trade as well.
Again, that stop loss will limit your losses and put a floor and a kind of a little base underneath which you won't lose anything more than that given percentage.
Yeah.
So let's talk a little bit about how you can get started. And again, you guys might feel like a newbie like me. I'm a newbie in this area because I have not done options trading. And certainly the next thing would be for me to ask my girl, okay,
yes,
we got to get a little, I might get a little one-on-one here with Teri,
That's pricey.
I know I was supposed to say, well, okay, let me see. How can I cash app you? What can I do here? I don't know.
Cash app don't go high enough.
Okay. You're like, pay me. Then you got to add a couple more zeros to the mix there. But I do strongly recommend. I have taken Teri's course. I have not taken her VIP course yet. And that's the next thing for me, obviously, to go ahead and take. Mainly because I've been so crazy busy and I have such a ridiculous schedule all the time. But I love the idea. I love the idea of learning how to trade and make money in different ways. And so that's why I think the VIP course, and I know because I'm, with her a lot and following a lot on all the people who are making $1,000 a day that she's been teaching them how to trade successfully. Yeah, $1,000 a day. In a day. But the just growing number of your students who are just doing it. It's
We're
not
at 20,000 students. Can you believe that?
That is incredible. That's incredible.
Crazy.
And it's not like rocket science, but there is methodology. There is a system. There is a strategy behind this. And that's what I most got out of the class. That it's not random. It's not willy-nilly. It's not, oh, my gut instincts. I think I believe. Oh, no. You got a chart. Okay. Yeah. You have to understand how to fundamentally trade stocks in an efficient manner. And so the idea here with options trading is first, you need to learn how to trade the stocks first.
Yes.
And then you can get more sophisticated and go to things like options trading, or even in the VIP class, I know you teach about short selling as well.
Gaps and Globex. You know what, Lynette? I think actually it'd be good for me to say like what are in the 8 weeks of the course.
Sure.
So the course is only 8 weeks. It's super fast. You learn everything you need to know about how to become an investor, a trader, an active investor. And the first week we talk about how to pick good companies because that's super important. Yep. Then we go into how to protect your risk. These stop losses that we talk about, but there's a whole risk management plan to protect you from losing. Then we go into charts, and that's how do you know what price to get in and what price to get out of a trade. That's something you'll find in charting. Then you put it all together into a trading plan so that you're not always trading with your gut and emotions. Like, nope, these are the 7 steps. Take them every time you take a trade, and you'll start seeing consistent returns like the $1,000 in a day or more that my students are starting to make. Then we go into the advanced side of the course. So week 5, we're talking about short selling. How do I make money when the stock market is falling? That's short selling. Then gaps and Globex. If there's news or something happens overnight, how do I take advantage of that? That's called gaps and external trading, right? Globex. And then finally, week 7 and 8 are about options trading. So now that you got stocks down, now we'll talk about these 100 shares per contract. Mm-hmm. And it's so I can't talk enough about how cool options are and how they've impacted my portfolio. So I can't wait to see you in the VIP program because it's really, really cool. And I'd love to teach you.
And you know what, you guys? Yeah. If this sounded a little bit complicated, it's okay because you got to walk before you can run. You got to crawl even before you can walk. And so some of what we're trying to do here and make it make sense is to break down some of the language, the terminology, the concepts, and the strategies to help you to become a more successful investor. The more you listen, the more you learn, the more you hit that like and subscribe button and follow us along to get more insights into investments. And again, we're not financial advisors. Disclaimers up front. We're not giving you, specific investing advice to follow, etc. We're talking to you about our shared experiences and our knowledge, and we're giving you a framework so that you can make better investing decisions. And we want you to win. We want you to be really super successful at your investing, whether you're more of a long-term investor like myself, or whether you're a trader and an active investor like Teri, or you do a combination and you kind of do a hybrid of both. Yeah, because she's gotten me more to doing trading a lot more.
To the dark side.
Over to the side. Yeah, before, I tell you all of my background as a financial journalist previously, I was a Dow Jones and Wall Street Journal reporter. I was a CNBC reporter. I've written books on investing and on a whole bunch of money management topics. But throughout my life and career, they acted like, oh my gosh, you can stay away from day trading. It's like only the professionals. That's, only the smart guys on Wall Street. And I'm like, y'all was just trying to keep us out of this stuff. Okay. This was because now I'm seeing like, oh, wow, there's a lot more that you can do once you learn a strategy, once you learn how to put it into force every single time, right? Because people are going to tell you X number of people lose money day trading. And it's true because they're doing it willy-nilly. They're just randomly and just going by gut instincts. Yeah. But when you have a proven methodology, like what you get with Teri, then it's all bets off. Then it's like, okay, I'm successful because I've learned how to trade properly. Yeah. Mm-hmm.
Guys, you could trade just one stock. I think people get overwhelmed because they think if you're a day trader or a swing trader, you have to be trading this whole portfolio and you have to have 1 million screens up. Guys, you don't have to have any of that. You could trade the same stock every day, or you could even stop trading. Huh, what? You can? Yeah, if you make some money and you do well on one trade, stop trading the rest of the year. Now you just beat all the naysayers.
Indices, all the averages,
because you made money on a stock. Yep. So don't be afraid. And sometimes
it's actually a good idea when you need to take a little emotional breather from the market when there's so much volatility and you're not seeing the right entry or exit points. That is the time to stop trading, right? I mean, you don't have to say, even if you're a day trader, you don't have to literally say, okay, I must be in the market, every single day. The market is open. Yeah. The market is open and the market closed. I need to be in there. Mm-hmm. Take your time with it. Learn, do your homework, do your research, and make it work for you.
Exactly. We'll see you next time. I hope you learned a lot from this episode.
Thank you guys for watching. Don't forget to hit that like and subscribe button too.